Trump's trade war escalation, the EU's strategic countermove and the future of transatlantic relations. The escalation of Trump's tariff policies, a multi-phased assault on global trade. The Trump administration's second-term trade policy has been characterized by rapid and sweeping measures aimed at reshaping global commerce. On February 26, 2025, Trump announced a 25% tariff on all EU imports, explicitly targeting automobiles, steel and aluminum, key sectors for Germany and other EU industrial powerhouses. This move was framed as a response to the EU's unfair trade practices, including its 10% tariff on U.S. passenger cars and value-added taxes, VAT, averaging 17.5%. By April 2, the administration escalated further, imposing a 20% blanket tariff on all EU goods under the guise of reciprocal trade measures, a term critics argue misrepresents unilateral protectionism. The tariffs were implemented in three waves: steel and aluminum. On March 12, 2025, Trump reinstated 25% tariffs on all steel imports and raised aluminum tariffs to 25%, revoking exemptions granted during his first term. Automobiles. A 25% levy on foreign-made cars and auto parts followed on March 26, directly impacting Germany, which accounts for 20% of global automobile exports. Broad-based tariffs. The April 2 Liberation Day executive order imposed a 10% baseline tariff on all imports with higher rates up to 50% for 57 countries. The EU faced a 20% rate, compounding existing sectoral tariffs. The U.S. trade-weighted average tariff surged from 2% to an estimated 24%, the highest since the Smoot-Hawley Tariff Act of 1930. Trump justified these measures as necessary to address the hollowing out of U.S. manufacturing and reliance on foreign supply chains. However, economists widely criticized the approach, noting that trade deficits are influenced by macroeconomic factors like savings rates and exchange policies, not merely tariff imbalances. Targeting the EU's economic core. The EU's automotive sector, which exported 50 billion euros worth of vehicles to the US in 2024, faced immediate disruption. German automakers like Volkswagen and BMW saw production costs rise by an estimated $15 to $20 billion annually, forcing price hikes for American consumers. Similarly, the 25% steel tariff threatened 28 billion euros in EU exports, destabilizing industries in Italy, Spain, and Poland. Trump's rhetoric further inflamed tensions. He dismissed the EU as a pathetic entity designed to screw the United States, singling out non-tariff barriers on U.S. poultry and digital services as evidence of systemic unfairness. These comments underscored a broader disdain for multilateral institutions, with Trump framing the World Trade Organization, WTO, and EU as obstacles to America First priorities. The EU's strategic retaliation precision targeting of political vulnerabilities. The European Commission's retaliation was both measured and politically astute. An internal document revealed plans to impose 25% tariffs on 22.1 billion euros of U.S. exports strategically selected to pressure Republican-held states. Agricultural products like soybeans, pork, and bourbon, staples of states like Iowa, Texas, and Kentucky, were prioritized, alongside manufactured goods such as motorcycles targeting Wisconsin's Harley-Davidson and cosmetics, affecting Ohio's Procter & Gamble. This approach mirrored the EU's 2018 countermeasures but with greater precision. By aligning tariffs with U.S. electoral politics, the EU aimed to fracture Republican support for Trump's policies. European Commission President Ursula von der Leyen emphasized that the goal was not escalation, but to rebalance the situation and protect the EU's interests. The digital front, expanding the battlefield. In a significant escalation, the EU threatened to extend tariffs to the digital sector, targeting U.S. tech giants like Meta and Google. A proposed digital advertising tax, mirroring France's earlier digital services tax, could cost US firms €8 billion annually. Additionally, restrictions on cloud services and intellectual property rights were floated, potentially barring companies like Apple from charging for iOS updates in EU markets. This move reflected the EU's growing assertiveness in regulating tech dominance, but it also risked alienating member states reliant on US investment. Germany, for instance, opposed measures that might disrupt its automotive tech partnerships with firms like Tesla. Mobilizing the anti-coercion instrument. For the first time, the EU activated its anti-coercion instrument, ACI, a mechanism approved in 2023 to counter economic intimidation. The ACI allows the bloc to impose counter-tariffs, restrict public procurement from offending countries, and limit intellectual property rights. France and Germany spearheaded this effort, framing it as a defense of EU sovereignty against US bullying. The ACI's deployment signaled a shift from reactive to proactive trade defense, with the EU leveraging its collective market power, €15.8 trillion GDP, to deter unilateral US actions. However, internal divisions surfaced as Hungary and Poland expressed concerns about provoking further US retaliation. The 90-day truce, a fragile negotiation window, the suspension and its strategic implications. On April 10, 2025, Trump unexpectedly announced a 90-day suspension of higher tariffs, reducing them to 10% for nations engaging in good faith negotiations. The EU reciprocated, pausing €21 billion in retaliatory measures slated for April 15. This pause, however, excluded existing sectoral tariffs, 25% on steel, aluminum, and autos, which remained in force. The truce was less a concession than a tactical reset. Trump faced mounting domestic pressure as U.S. equity markets lost $4 trillion in value over the preceding week, and the Federal Reserve warned of an impending recession. Meanwhile, the EU sought to avoid a prolonged conflict that could shave 0.6% off Eurozone GDP by 2027. Financial markets, a roller coaster of panic and relief. Stock markets oscillated wildly. The Euro Stoxx 600 plunged 2.7% on April 2, with automakers like Volkswagen and BMW dropping 9 to 11%. Maersk, a global trade bellwether, saw shares fall 9.5% as shipping volumes contracted. The euro initially spiked to $1.09 on. The April 10 truce brought temporary relief, with the Stoxx 600 rebounding 3.2%. And the Dow Jones gaining 450 points. However, bond markets signaled lingering anxiety. German 10-year yields fell to 1.2%, while U.S. Treasuries surged to 4.3%, reflecting a flight to safety. Automotive EU car exports to the U.S. dropped 18% in March to April 2025, with German manufacturers redirecting 40,000 vehicles to Asian markets. Agriculture EU tariffs cost U.S. pork producers $1.2 billion, while European cheesemakers lost €300 million in sales to the U.S. tech Meta and Google stock, fell 7 to 9% on digital tax fears, though both companies announced price hikes for EU services to offset losses. Geopolitical shifts. The EU's pivot from dependency, strengthening internal unity. Paradoxically, Trump's aggression has accelerated EU integration. The bloc fast-tracked the Capital Markets Union, aiming to mobilize €3 trillion in private savings for intra-European investment. By harmonizing insolvency laws and streamlining stock market regulations, the CMU seeks to reduce reliance on U.S. financial markets. Similarly, the EU revived plans for a savings and investments union, targeting non-tariff barriers that cost member states €140 billion annually in cross-border service trade. Trump has given us the urgency to finally complete our single market, remarked German Finance Minister Christian Lindner, diversifying trade partnerships. The EU has aggressively courted alternative markets to offset U.S. losses. India, a free trade agreement finalized in March 2025 eliminates tariffs on 94% of EU exports, including wines, dairy, and machinery. Canada, the Comprehensive Economic and Trade Agreement, or CETA, was expanded to include digital services, benefiting EU tech firms, Mercosur. After a decade of stalemate, the EU-Mercosur trade deal was ratified, granting access to Latin America's €2.8 trillion market. These moves align with the EU's open strategic autonomy doctrine, which emphasizes reducing dependency on any single partner. Security concerns and the NATO dilemma. Trump's concurrent withdrawal of support for Ukraine has forced the EU to confront its defense inadequacies. The bloc approved a €100 billion European Defense Fund in April 2025, aiming to coordinate arms procurement and reduce reliance on U.S. equipment. Negotiation dynamics, carrots and sticks. The EU's negotiating position centered on a zero-for-zero tariff proposal for industrial goods, eliminating duties on cars, pharmaceuticals, and machinery. This mirrored the stalled transatlantic trade and investment partnership talks but faced skepticism from U.S. negotiators demanding concessions on agricultural market access and digital regulation. As former U.S. Trade Representative Robert Lighthizer noted, the EU wants free trade for its cars but won't accept our chickens. That's not reciprocity. Economic fallout and market reactions. Immediate disruptions in global supply chains. The tariffs triggered immediate supply chain chaos. European automakers, reliant on just-in-time parts deliveries, faced production halts as US-sourced semiconductors and wiring harnesses became 20 to 25% more expensive. Airbus, already competing with Boeing, warned of delays in its A320neo program due to tariff-inflated titanium prices. U.S. agricultural exporters suffered equally. Soybean futures fell 12% as EU buyers shifted to Brazilian suppliers, while Kentucky bourbon producers reported a 30% drop in orders from Europe. The American Farm Bureau Federation estimated losses at $5 billion annually, exacerbating rural discontent.